Hello and a warm welcome to Accommodate Unplugged on Tuesday, the 19th of January 2021. Mark Pender's across the pond stateside, and I'm Jeremy Hawkins here in London. Well, politics looks pretty messy almost wherever you choose to cast your eye at the moment, and not least in Europe, where the Dutch cabinet resigned last week, and as we record this podcast, the Italian government is in danger of collapse. So not good news for speeding up an already behind schedule vaccine rollout. Still, financial markets are clearly expecting Joe Biden's inauguration on Wednesday to open the door to further fiscal stimulus, and the prospect of higher taxes for corporates and the rich, as well as increased consumer protection, have so far seemed to be largely ignored. It's going to be interesting to see how long such a seemingly blinkered focus can continue. In any event, last week we had a broad range of updates on the US economy, ranging from retail sales to industrial production and inflation. So, Mark, how do you think look now, and assume you can get it passed, of course, do you think this new near $2 trillion Biden package is going to be enough?
Enough to patch over the economy until the
Enough to get things
vaccines.
going again. Everything else, stop the slowdown.
It seems like it would be a reasonable place to start, and a good idea, and certainly the economy needs it. Whether or not it's going to be enough, we'll have to see how successful these vaccines are in reducing cases. Right now, it looks like cases in the U.S. are on a decline, but they're from a very, very high level. So we'll have to see how that unfolds. We'll also have to see how quickly Biden can get everything in gear. I imagine it's going to be faster than not, given the urgency and the fact that he does have however marginal, he does have control over the Washington government. So, and I think, last week's data definitely are putting a heat under, the need for more emergency help. And it was just besides the retail sales and industrial production, which came in on Friday. It was the Thursday before we had a giant spike in initial jobless claims, which came in at 965,000, which was totally an unexpected move. It had been under 800,000. And that combined with what was a very soft and negative contractionary non-farm payroll number in the week before for the month of December, there are warning signs that the labor market is cracking in the U.S., and this is going to be tilted entirely toward the lower end of the labor force, and that speaks to the necessity not only for emergency stimulus, but for things like eviction, a moratorium on convictions, which evictions, which Biden I may be extending deep into this year. Let's go back to retail sales. We're getting the weakness there. We had a 0.7% decline at the headline level, which was much more than a 0.1%, which was the Econoday's consensus. Really, the outside of vehicles, which are being supported, like the financial markets, by low interest rates, there was just broad weakness in the categories of department stores, electronics and appliances, and non-store retailers had a very surprising sharp decline in the month. So that was not good news. And of course, restaurants have been collapsing. So that really does signal the need. In contrast, we had industrial production, which did well. It's still under where it was in February before the pandemic, but the path has definitely been improving. And what's interesting about here is the strength in the capital goods areas, specifically machinery, which and this falls in lines with other data and other, as well as anecdotal surveys, sentiment surveys, that businesses are, in fact, U.S. businesses are investing aggressively in new equipment. So that's a very positive sign. I'm wondering now if some of this is from all the monetary and fiscal stimulus that I think is finding its way into the housing market, is finding its way to the financial markets, may also be finding its way into business investment, which is probably the best place for it to be finding its way into a very important area that will make U.S. businesses more competitive when all this, hopefully, this COVID pandemic stuff is all, some kind of a nightmare, a past nightmare for us all.
Yeah, right. I mean, certainly, I guess, as far as Europe's concerned, the investment numbers, at least in things like plant and machinery anyway, are running well behind what you've been seeing on your side. Germany, I suppose, has seen a little bit of an improvement coming through there. By and large, I think the likes of the ECB and the fiscal policy makers as well, they must still be concerned about the way that, by the looks of it anyway, investment has been hit disproportionately hard by COVID. And with businesses still so unsure about the future, a lot of companies are clearly cautious about introducing new aggressive spending plans, even as we start to move through 2021.
We had the German, speaking of economic sentiment and sentiment, we had the German ZED, how do you say that? The ZEW survey.
Yeah.
So it looked pretty, what did you think?
It's kind of, I suppose, following the sort of pattern we've seen since the announcement of the vaccine rollout back end of last year. So ostensibly, by and large, analysts, and this is really just a survey of financial analysts, what they think about the current state of the German economy and what they think the outlook's going to be like over the next 6 months or so. So we really saw no change in how analysts perceive the current position. So it's still very gloomy. Really of the kind of levels you would think would indicate that people are expecting GDP to produce at least some kind of immediate contraction. But in terms of optimism, looking at sentiment regarding the future, I mean, that's miles above its kind of long run average. And it really does just reflect the fact that, yes, people are worried about the implications of the ongoing lockdown. Mm-hmm. Indeed, having mentioned that's expecting to get an announcement about an extension of that from the Merkel government today. But they're also equally that much more optimistic about the vaccine rollout, although to be honest, that's been somewhat behind schedule to date. But clearly it's boosting optimism that vaccine rollout, together with all the spending, all the quantitative easing we've had coming out the ECB, sets a positive scene for the second half of the year.
And that's the business investment angle in the U.S. that I was talking about, that sentiment there of the post-vaccine world and getting ready for that.
Yeah, it's going to be interesting, isn't it?
Well, we also have the ECB, so that's on Thursday. And so tell us what you think about that. And we also had an ECB Lending Survey today.
We did. It's worth, I think, it's the Ecb Lending Survey, which is a quarterly survey right across the region's banks to see what they're doing with their credit standards and what they expect to be happening to loan demand going forward. It's one of those surveys which markets tend to ignore because there's an awful lot of text in it and probably not enough numbers. But in actual fact, as the ECB really highlighted in December, one of the crucial reasons why they introduced their broad-based easing package last month was due to the fact that they were getting concerned that although by and large financial markets were working pretty smoothly, we were starting to see some fairly significant tightening of lending standards, which could depress loan demand and hence recovery over the rest of the year. So today's survey, which was for the fourth quarter of last year, that showed exactly the same sort of pattern. So we saw a tightening of lending standards on top of the previous period's gain in the third quarter, both for households and for corporates as well. So now, is that going to be enough to make the ECB want to ease again on Thursday? Almost certainly no, because as we mentioned, they had their big sweeping easing package introduced really just a few weeks ago. But it's one of those factors which I suspect means we're going to have the likes of Christine Lagarde during her press conference adopting a decidedly dovish tone and basically pointing out, we continue to stand by to do whatever might be necessary in order to get the recovery, coming through.
Well, now what about the ECB specific efforts to increase the availability of loans and have this pass through into borrowing?
Okay, well, they've got a number of different aspects to their program. It really is multi-tiered now. I think people are used to the well-known phrase quantitative easing. That is still going to run for the rest of this year, unless they change it on Thursday, which I think is very unlikely. So the old asset purchase program, which has been around for such a long time now, that's going to be net asset purchase of 20 billion euro every month. So that's unchanged from last year, and they seem to be quite happy with that at the moment. The PEP. The Pandemic Emergency Purchase Program, hence PEP, that's similarly expected to hold steady at its current level of 1.85 trillion. Of course, that was hiked by $500 billion in the December meeting, and that's really their main quantitative easing tool now. But in terms of sort of getting down to targeted efforts to make sure financial markets are working properly, it really comes down to their refinancing operations. Now here they have a couple of real measures, or instruments, I should say.
And this is your targeted longer term refinancing operations, and it
Well
comes
said.
out to. And what's the acronym? How do you say the
Correct.
acronym?
So so it's targeted longer-term refinancing operations, or TLTROs, as people like to call it for short, because otherwise it takes up most of your afternoon to say it. So they are really just means by which banks can access extremely cheap government funding, so long as they on loan those funds to the corporate side or to households.
And according to this lending survey, that's not accelerating, or that bridge right there.
Well, it does look, I must say, as if it's increased caution in terms of the lending side now. During a chunk of last year, by and large, and it's safe to say even that the lending numbers held up relatively well, but not brilliantly by any means. But this latest survey just holds out a few warning signals, I think, that perhaps we're going to start to see lending slow down a little bit. It may not happen because, as you say, it's only a survey, but certainly it's pointing in that direction.
Well, in the U.S., the Fed, with its facilities, its number of facilities that range from small business to large businesses, medium-sized businesses, there have been very little take-up, a marginal take-up in loan demand, and Jerome Powell's explanation is that borrowers don't want the money, that they either don't see themselves creditworthy enough to being able to pay it back, or they don't need it. What about the demand side? It's not just the supply side is available in the banking loans, but is there demand for these loans?
Yeah, and that's exactly the right question to point to make. I think it's all very well having the ability to go and lend these funds, but it's like taking the proverbial horse to water. You can't always make it drink, and that may be what we're starting to see coming through in terms of some of these eurozone figures now. The supply, I think, by the looks of it, is available, but we can't guarantee that if the actual demand for loans is going to be as high as the ECB would want to see. Mm-hmm. I mean, if you're looking at the breakdown of, as I recall from some of the M3 data, certainly for November anyway, non-bank private sector borrowing was running at 4.8%, which, to be honest, is pretty well close to the historic norm, really. So it's doing okay, but it's not doing as well as you might hope, given how low interest rates are, the amount of money being poured into the economy at the moment. Where we are seeing strong borrowing coming through, of course, is on the government side. I mean, banks' purchases of government debt securities is up about, as I recall, about 27% or so on the year, and that's really tells you what's happening with this QE. So there's an awful lot of liquidity sloshing around, but it still remains to be seen whether it's the case it can actually be directed to where it's most going to be needed. And as you say, if at the end of the day, corporates, firms, whatever you want to call them, don't want to borrow because they're not comfortable enough about the economic outlook, it doesn't matter how much money you pile into a system, it's not going to have desired effect on the real economy.
Mm-hmm. Yeah, pushing on the string.
Yeah, exactly that. Very much so. Well, no, I should be saying from my side. So, did a bit of politics. I should mention some politics coming out of Europe at the moment, particularly with regards to Germany. Well, in fact, Eurozone I should mention first, because we talked a lot about the COVID rescue package, which they finally managed to agree at the back end of last year. Well, we'll have finance ministers as of today. So the finance ministers from the various EU states are due to discuss the national plans that they have to submit to the EU Commission to actually get their hands on this stimulus package in the first place. And there are some signs that the more hawkish countries like Germany are very keen to make sure that these funds are going to be put to good use to address countries' structural issues, or basically they're not going to get the money. So it's going to be something to keep an eye on there to see whether or not, having finally got agreement on the package, whether it's actually going to be dished out as individual governments.
Well, this is what's messing up Italy. Is that right? We're in a limbo now in the Italian government because of the majority party disunity on how to divide up the funds?
Yeah, well, certainly that's right. I mean, at the moment, as it stands at the moment, saying we literally, as we record this, I think we're due to get the vote in the Senate almost at any time now, which will determine whether or not Giuseppe Conte, the current prime minister, is actually going to survive. But as you mentioned, we saw one of the junior partner, the Italia Viva member of the current coalition, which consists of the anti-establishment five-star movement and the centre-left Democratic Party. They quit, and as you said, it was really over plans about how to tackle the economy post-virus. And the differences there are significant in the sense that if the Prime Minister were to lose the vote today, it does mean that the president could try to form another kind of government using same parties or different parties or whatever, or we could go back to, again, having yet more early general elections in Italy, which is not going to be good news.
Has this affected Italian bonds any?
It has a little bit, I think. I mean, looking really at where spreads are, I think you've got to say that by and large, markets, investors still want to buy bonds. Yes, we've seen yields pretty well, across all the market rise somewhat since the beginning of the year. But there's spreads, been looking at BTP spreads over German bonds. They've hardly moved on the back of this news. I guess that's partly a reflection of the fact that instability in Italian politics is more of the norm than the unusual. But, things like this, I think, if the government's got real problems, it's not going to help the vaccine rollout program. Go further north in Europe to the Netherlands, and the Dutch government there resigned over child welfare fraud at the back end of last week. Now, although it's going to continue as a caretaker government, and there were elections scheduled for the 17th of March anyway, so it's not that big a deal. But again, it's probably not going to help the rollout of the vaccine. And there's little things like that at a time when, markets are looking for good news, and good news currently is all about, we've got a vaccine coming. Well, anything which disrupts that delivery really can't be good news. And of course, I don't think it affects your side, but over here, the Pfizer BioNTech vaccine. Pfizer announced that they would be delaying some of the scheduled deliveries over the next few weeks to European countries because they want to beef up their production of the vaccine to allow for greater production over future months. So
they're doing some kind of retooling in the production.
Exactly that, which of course should be good news medium longer term, but over the next month or so perhaps it means that some EU countries will not be receiving the quantity of the vaccine that they originally expected, which work it through to its logical conclusion means that may mean perhaps that restrictions or even lockdowns are going to have to last that much longer.
Well, let's see. I'm just looking at the calendar. You're going to do a Bank of Canada announcement tomorrow. What do you see for them?
I suppose central banks, which might have a smile on its face at the moment, but it's probably looking over its shoulder and thinking, well, we're not doing too badly. Now, we did have a weak December employment report, but crucially, we've also had a pretty bullish Bank of Canada business survey. And I think, taking all the numbers together, clearly it's been hit by COVID, but by and large, the economy is still doing okay. So our expectations for Wednesday are really nothing. Wouldn't surprise me to get almost a repeat of the communique we saw last time around. So crucially, the overnight rate target is going to remain at 0.25%, and the quantitative easing side of it probably still 4 billion Canadian dollars per week. That said, it's interesting. I noticed there was a survey out, I think it was last week, which suggested that a lot of analysts now are looking towards the Bank of Canada beginning to taper, possibly before the end of this year. And certainly looking around Europe at the moment, you're not going to find too many central banks which are even contemplating the idea of tempering this side of the water.
That'll be interesting to see what to expect for when the other banks they announce their tapering, to see what the impact will be in Canada.
Yeah, that's right. I think certainly Canada at the moment, I mean, clearly things may change, but in terms of where the economy is performing, it does seem to be somewhat ahead of the pack at the moment. And talking ahead of the pack, now I know you've been scribbling some bits and pieces on China due to our colleague Brian being away, and on the whole, good numbers.
Yes, I'd say so, except for retail sales. Production's very strong there. I think that reflects a lot of global demand for Chinese products. And we had the GDP. What did it come in at? I think 6.1, which was better than forecast. No, 6.5 year over year. The consensus was 6.1. But the retail sales and fixed asset investment was solid, and industrial production was solid. But retail sales came in, growth there slowed from 5% in November to 4.6%. And that was almost a point below expectations. And, even though the monthly gain at 1.24%, that's a strong gain. There's slowing going on there, and that can't be good for the global economy. Not that I'm not sure. Certainly, the U.S. doesn't sell very many consumer goods to China, but countries that do, they don't want to see slowing in Chinese consumer demand. And I think that is a key to the 2021 economy, is that not only Chinese consumers but also Chinese businesses. They really do need to invest in their trading partners and spending on non-Chinese goods and services, and I think an aggressive rate, and that to help their customers, because of the Chinese economy is doing so well. But the Chinese economy is really going to be the center, I think, of the 21 global economy, and it's going to be the source, the driving engine, hopefully, for this year.
Well, I must say, looking at the capital inflows going into China at the moment, despite all the various restrictions that the outgoing U.S. administration tried to impose, capital inflows into China have been huge, and there's obviously still a lot of confidence, as you were saying, that China will do well during 2021. I suppose it's worthwhile just pointing out, when you think about, let's be honest, for most countries, 2020 is just a case of how big a negative is the sign going to be in front of GDP. Well, 2020 growth in China last year was 2.3%, if I remember. So they actually managed a positive handle on it, which really is quite remarkable given what was going on elsewhere in the world.
Yeah, let's see. That was 2.3 versus 6% in 2019. So yeah, it was up. At least it grew.
Pretty impressive going.
Mm-hmm.
Right, from my side, a couple of things. One thing I should certainly mention, we had the election for the new Christian Democrat Union leader in Germany at the weekend. Why is that important? Well, it's important because the new person will be replacing Angela Merkel, who, of course, been effectively the queen pin, I suppose I should say, of politics across Europe for the last 15 years or so. So it's going to be a centrist, Armin Laschet, who's currently the premier of the North Rhine-Westphalia state, who'll be taking over from Merkel. Doesn't guarantee that he'll become the chancellor, of course. We've got to wait for the elections or everything else in September before that. But it's crucial, I think, from market perspective, it's going to be seen as more of the same, in the sense that he's been very much a loyal Merkel supporter. So it does seem as if, even though Merkel's going to be disappearing, her replacement, albeit with big shoes to fill, will be following the same sort of path in terms of German policy as we go forward. And lastly, from my side, at least in terms of the numbers this week, we get the PMIs, the flash PMIs for January. They'll be due out on Friday. As we said in the past, they're the sort of really the biggest economic indicators we get as far as Europe's concerned. And expectations there are, well, I suppose just a reflection of the ongoing COVID-19 crisis. Just to summarise it in one number, the headline composite output index for January, the expected value there is 47.9, down from 49.8 last time, and so is that little bit further into recession territory. So if it's right across, I suppose it kind of sums up the state that the European economy is in at the moment.
Okay. Well, on the U.S. side, just to follow up, we also get the PMI composite flashes, and here the consensus is a mid-50s reading, which would be pretty strong and steady rates of growth, although that's not a market mover here in the U.S. What is a market mover is Thursday's jobless claims, and the consensus is for a significant decline from the prior week spike, 890,000 versus 965, which we talked about earlier. But that what happens is that prior week scrambled the whole pattern there. So what had been a very steady, predictable thing, at least for a month or so, or through the month of December, has now become an unpredictable thing. Other than that, we're going to get housing data, housing market index tomorrow, which has been through the roof. These are home builders, unmatchable. Record soaring gains, and housing starts and permits that'll follow that. That'll be on Thursday, and then existing home sales on Friday, and then new home sales the following week will cover up. We'll finish up the latest in the housing sector, which will be poised. We'll wind up what 2020 look like, which was a phenomenal year. Although the housing market index tomorrow will be for January, for this month's sentiment among home builders. So that'll give us a little hint of what to expect for the beginning of this year.
Yeah, housing, I think a lot of countries has been one of the few areas we've had relative growth. Just a quick one before we end up in terms of these PMI, because it is quite interesting looking at how strong your headline numbers, excuse me, how strong your headline numbers are compared to what we're seeing across much of Europe. So I'd ask if I've got it in front of you, but I'm just looking at, well, the December numbers we had. I mean, weakness in Europe was, as we talked about before, very much concentrated in services. So the service sector PMI over here, with Eurozone, was just 46.4. What's your counterpart number over your side?
We were at 55.3
for services.
If you give me a second here, I'll call up the ISM does a services index, which is more closely watched, and it's always runs very, very strong. So how do we explain why these in the U.S. All these
I mean, here it's
surveys.
easy. Here it's all about lockdown, so it kind of makes sense. I'm just curious to know why your number seems to be so high relative over here. Is it just our restrictions so much tighter?
Oh, I think that's it. Also, also the retail sales in like Europe that you've been talking about, they fell off
fell out of bed.
They fell out of bed, and you can look at the
down,
graphs in November and December. Just it dropped. We didn't see that here. We did go down, but nothing as steep, and I think that's tied very directly to much less restrictions here. What we have seen. Okay, so how do you explain the elevated levels, not in just the national PMIs and the ISM, but also in the regional manufacturing services from the Feds? Those have all also been very, very strong. It's that sentiment. It's that, these are, there's the post-vaccine world is being anticipated. But what has been lagging in these reports is employment. And employment, for instance, in the last ISM came in at 48.2. That's in contraction. And on the manufacturing side at ISM, it had been in 48.4 to move to 50.5. So they're not hiring. And they blame they don't blame their own demand. They say, well, we want to hire, we just can't find people because people are concerned about COVID and childcare and those things. And there's also a lot of absenteeism. They're complaining about absenteeism. So anyway, these firms that are involved, and then we're talking about the labor market and the jobless claims spiking and the contraction in payroll. So that is however much some of this data or much of this data isn't correlating with what we see in the definitive part.
Yeah, right.
It is when it comes to the most important part of all, which is employment, which is a big wound right now in the U.S. economy.
Yeah. Unlike over here. Okay, well, let's wind it up there then for today. I guess we've been talking for long enough. So, on behalf of Mark and myself, thanks as ever for listening. We'll be back next week with a new president and hopefully better news on the virus. And in the meantime, do remember, keep up to date with all the key market moving data and events in Econoday's global economic calendar. Bye for now.